Good afternoon, everyone. This is Paul Gianamore from the Potomac Company. Today's presentation is Pest Control Valuation and M&A 101, the Fundamentals. Today we're going to do something different. In fact, we're going to do something very different today. Typically, these presentations, webinars, and live events are reserved for Potomac Company clients. After last month's presentation, one of our long-term clients asked if I wouldn't mind if he invited some industry colleagues and friends to this month's presentation, which I thought was a fantastic idea. And in fact, I'm going to go ahead and take it a step further. This presentation is going to be recorded, and we're going to put this on our website. I think it's a fantastic way to give back to the pest control industry. There's a lot of misinformation floating around out there that causes managers and owners to make horrible mistakes. So this is just a nice way, I think, of giving back. So I won't be as candid as I've been on some of the past presentations if you've been with us on them. But either way, I think today is going to be a lot of new information for you folks. We're going to really focus on doing some things we haven't done in the past. We're going to go over the fundamentals today, and some of the fundamentals include the fact that every business has a range of values. It's a very difficult topic for business owners to get their heads around, so we're going to spend some time on that. We're going to talk about how strategic acquirers value acquisition targets. We're going to discuss the dangers of acquisition multiples, as well as we're going to talk about how the market has changed over time. Again, today we're going to focus on fundamentals, and then in October, we'll start hitting Valuation and M&A 102 and 103, which will cover more advanced topics. So basically today is fundamentals of valuation. 102 will be the sell-side process and valuing a business from a sell-side perspective. And 103 will begin to focus on the actual transfer of a business entity to managers, employees, and family members. Now you noticed Project Zulu was on the title page. We called this the Project Zulu dilemma. As an investment bank, it's pretty typical for us to give our clients code names in order to preserve confidentiality. Project Zulu in this case is a fictitious pest management firm. We are going to use somewhat of a case study format for this presentation. So we're going to focus on Project Zulu, a fictitious pest management firm that's owned and operated. And I chose this sort of case study for fundamentals because, when I look at our dialogue box here, we've got 94 folks on this call right now. It looks like, based on the guys that I know, range in value, or range in revenues, I should say, from about 1 million in sales to we've got a couple of guys doing north of 50 million. So it's a pretty broad range, but I think this case study will pretty much cover 95% of you folks. You'll be dealing with these issues at one point or another if you're not dealing with them right now. So back to the case study, our owner is contemplating either an internal transfer to his children or an external sale. So our mission today will be to advise him on some strategic alternatives. And we're going to largely look at what the business is worth to him as a shareholder, what it's worth to his children, as well as what it might be worth to strategic acquirers. And when I say strategic acquirers, I'm typically referring to Rentokil, Orkin, and Terminix, and I call them the big three. Some facts on Project Zulu. The business is doing $13 million in sales. Henry's 67. He's a second-generation owner. He's the chairman and CEO. Gordon, his son, is 39, and he's the president of the business. The company's organized as a C Corp in the United States. Henry owns 100% of the stock and has 2 children who are not involved in the business. When Henry comes to us, he has a few questions. First off, he wants to know, of course, what his business is worth, but he's also interested in how he can go about selling it to his children, as well as, if his children are interested in the business, how he can sell it to a third party. Starting with the question of what it's worth, that typically depends upon the purpose for the value. So, again, one of the things that's difficult for business owners to get their head around is the fact that their business has a range of values simultaneously. So any given pest control company might have 15 or 20 different values depending upon the purpose of the valuation. Bring a privately held business, you can't call your stockbroker up and buy and sell stock in a private business, and valuation is done at a specific point in time for a specific purpose. In this particular case, we have 5 values. Don't read too much into these numbers here. I pulled them out of thin air just for illustrative purposes. But this particular company, the fixed assets or the collateral of the business is worth $8 million, whereas it's worth $12 million from a cash flow perspective to the owner. That's the fair market value. All the way on the far right end, it might be worth $26 million to a strategic acquirer. So it's a big range of values, and we call these different perspectives of value standards of value. So fair market value is a standard of value. Market value, fair value, investment value, these are all standards of value. The 3 most common, which pretty much covers almost everyone on this call, you'll be dealing with one of these 3 at some point in your life. Fair value typically deals with divorces and dissenting shareholder partner disputes. Fair market value is promulgated by the Internal Revenue Service and largely focused on gifting, stock, and estate tax purposes. And investment value is the value to a unique acquirer. Today we're going to be focused on 2 standards of value. So we're going to focus on the fair market value. That's what the business is worth to the current shareholders or a financial buyer. So when I say financial buyer, I mean somebody or an entity that cannot create synergies when consummating the transaction. So that would be your children, your managers, other individuals. Investment value is what the business is worth to a unique acquirer. So if you take a business out to market and you get 3 bids tomorrow, one from Orkin, one from Rentokil, and one from Terminix, you'd likely get 3 different perspectives on value, 3 different investment values for one company. Now, whatever we're doing here at Potomac, whether it's a valuation for gift and estate tax purposes, whether it's a sale to children or a strategic third party, whether we're on the buy side or sell side, whenever we're valuing a business, we always start with fair market value because that tells us what the business is worth to current shareholders. And in this particular example, the company might be worth $9 million to current shareholders, and it might be worth $9 million if the shareholder sold it to his son, for example. But the business might be worth $14 million to a strategic acquirer, like a Terminix or an Orkin, for example, because Orkin can come in and buy the business. Orkin has different required rates of return, being a public company, and it can create some synergies, revenue enhancements, cost savings. So whenever you go to sell your business, it's important to, or transfer in any way, shape, or form, it's important to start with understanding what fair market value is and then bridging the gap to investment value. If you were to sell this business and it were worth $9 million to you, clearly your target would be that $14 million investment value. And if you're the acquirer, your target would clearly be to pay as close to $9 million as you can. So the sale process, the negotiation takes place ideally within that big blue box or the value creation zone. Within that zone, 1 + 1 doesn't necessarily equal 2. It might equal 3, it might equal 4. Of course, less than fair market value, the seller really loses, and greater than fair investment value, the acquirer does not create any value and is better off not doing the deal. So, in regard to Project Zulu, we're going to go ahead and start with step 1, which is determining fair market value. And in order to do that, we're going to access our Valuation Toolbox. This includes the 3 broad approaches to valuation. Those are the market, income, and asset approach. Now, the asset approach is largely related to valuing fixed assets, businesses that are capital intensive, which is not us because our pest control businesses are largely intangible. So we're going to focus on the market and the income approach. And today we're going to begin with the income approach because the income approach is the key valuation tool that investment bankers and acquirers use to determine the value of a business. The income approach quantifies the risk and return of owning an asset. Makes no difference what other individuals or companies are paying for a particular asset. It's based solely on what that business is worth on a risk-return basis. The income approach is what every sophisticated acquirer uses. So I know that in this industry, there's all sorts of rules of thumbs floating around: 1 times sales, 1.5 times sales, 5 times EBITDA, 6 times EBITDA. Rentokil, Orkin, Terminix, Arrow, Massey, these sophisticated acquirers could not care less about transaction multiples. Tell you as fact, Rentokil doesn't look at them, Terminix doesn't look at them, Orkin could not care less about sales multiples and EBITDA multiples. They use 2 tools within the income approach: the discounted cash flow analysis and the internal rate of return analysis, which we're going to talk about today. But first I want to walk through some of the basics. Now, we're moving right into some really quantitative type analyses, and I'll tell you, business valuation, in my opinion, tends to be almost more qualitative than quantitative. But because this is a short course today, we're going to focus largely on the quantitative aspects of valuing a business. From a fundamental standpoint, the value of a business is driven by 3 factors, and 3 factors only: cash flow, the growth rate in cash flow, and risk. When you talk about recurring revenue and people and long tenured employees and strategy and so on and so forth, these are symptoms. What we need to focus on today is the cornerstone, or what actually creates value, which that is low risk and cash flow. So if we increase growth rate or cash flow, value goes up. If we increase risk, value goes down. And of course that plays out every day in the public equity markets, in the sovereign bond markets. Countries that are riskier have to pay more interest on their bonds. Djibouti and Peru pay more on their sovereign debt than does the United States and Great Britain, although nowadays you'd almost think that the US and UK are probably more risky entities than these countries. We can depict this graphically here, almost mathematically I should say, that value equals free cash flow divided by the risk, the discount rate minus the growth rate. Now, you don't need to write this down. You don't need to remember this, because I'm going to bang it into your head today. But again, if we take cash flow going out into the future, we need to adjust it by the risk. So let me show you what I mean. So the firm has value because we expect to gain something from it in the future. And I just did a month or so ago, I guess it was last month, this is my 3rd time speaking at the PCT M&A seminar, and some of the folks that I listened to on the call, all great people, but they spent a lot of time talking about goodwill and how long your business has been around and so on and so forth, and those are all great things. But at the end of the day, a business has value for one and only one purpose: is what we expect to gain from it. The past, of course, could potentially be an indicator of the future, but it doesn't have much bearing in the value of the business. So we're focused solely on the future. So what a business is worth to the shareholders today depends on what it will produce for them in the future. If we can measure what the firm will produce in the future, we can determine its value today. So a very basic discounted cash flow model looks like this. Again, don't spend much time on this, because we're going to get deeper into it as the presentation moves. The problem that we have in forecast cash flow into the future is that the future is uncertain. We've got external risks. We've got the economy. We've got inflation. We've got competitors moving in and out of markets. We've got internal risks. Managers may get hit by a bus. Employees could quit. Place could catch on fire. So there's all sorts of risks everywhere we look. So it becomes very difficult to project cash flow going into the future. This is where a lot of judgment and experience comes into forecasting cash flow. And because of the risks, we have to discount the cash flow that we project into the future. Of course, the riskier the business, the more we have to discount performance, our future performance, and we call this the discount rate. All else being equal, this is why firms with higher degrees of recurring revenue are typically worth more, because there's more visibility on the future revenue stream. you have a client, whether it's a sell-side client, a buy-side client, a consulting client, or a valuation client, we always begin with fair market value, and we begin by populating an extensive and very detailed cash flow model. We refer to it as a transaction model, but it can be used for, quite frankly, anything. So what we've done here is we've taken Project Zulu and we've spread the numbers into a discounted cash flow model. Again, I'm not going to go into a lot of the qualitative aspects of valuation today, but we projected the revenue and cash flow out into the future. And using the cost of capital, or the required rate of return for private pest control companies within this size range, we've come up with a fair market value of $10.8 million. So you can see on the lower left, the WACC, which is the weighted average cost of capital, is 24.7%. And for businesses, for privately held pest control companies, the required rates of return are typically between 20 and 30%, at least for companies kind of doing between 1 and 300 million in sales. And of course, that 20 to 30% is a very broad spectrum, which can dramatically impact value. We'll talk about that a little bit later in the presentation. But what we've done now is we've determined the fair market value. This is what the business is worth to Henry. And one thing you'll notice is we use the income approach. We did not use the market approach, which deals with revenue multiples and EBITDA multiples. And if we take right from the discounted cash flow sensitivity analysis, the range of fair market value, when we refer to fair market value, it's typically a range because valuation is a range concept. We've got $10.5 to $11 million. That's the fair market value. And if you look on the right, you'll see implied valuation multiples. Revenue multiples and EBITDA multiples did not drive our valuation. These are implied. So if we take the $10.5 million on the far end, the left end of the range, and divide it by the company's total revenue, its trailing 12-month revenue, we get 0.77. So fair market value in this case, this business on a fair market value is worth about 80% of sales and about 4.5 times trailing EBITDA. So if we begin to put together one of the schematics that we did earlier, on the very far left-hand side, we can establish fair market value at $10.8 million for this business. Now, we talked about required rates of return. You know, the private capital markets are very different from the public sector or the public equity markets. In the private capital markets are segmented. Asset-backed lenders and banks will require a 3.5 to 8.5% return on their money, and it's quite low compared to the other investors because, of course, their investments are collateralized. There's liens on assets. They're above equity holders in the capital structure, so it's relatively low risk. As we start to get riskier, required rates of return start to run higher. We talk about corporates. Rentokil and Orkin, Terminix, they typically require rates of return between 10 and 18%. So that means when they look to acquire a pest control business, they're going to pay a no greater than a value that will afford them at least a 10 to 18% return. Mezzanine and sub-debt providers are 14 to 22%. And then the majority of you would be up here where it says PEG, that's private equity groups. This schematic here is based upon their most recent Pepperdine study of private capital markets. I quite frankly view this as extremely accurate. So most of you have required rates of return somewhere in the 20 to 30% range, actually probably closer to 24 to 30%. So you can see the difference between, this is where, when I discussed earlier that private investors will have different rates of return requirements. If Orkin is looking to get a 10 to 18% return and you want to sell your business to your son and he needs to get a 24 to 30% return, you can see how that dramatically impacts valuation. Now, we've determined fair market value based on the discounted cash flow model. Now it's time to take a look at investment value. So we're going to use the same projected income statement. We started in 2014 using the last 3 years as somewhat of a guide. Based on some qualitative analysis, we looked at average pricing, recurring revenue. We looked at strategy, people, architecture, routines, of the culture of the business, so on and so forth, projected out into the future an appropriate stream of cash flow, and then we discounted that back by the low end of the required returns for corporate acquirers. So again, Terminix, Rentokil, Orkin. And as you can see, our fair market value, our investment value, so we can call this kind of one of the higher investment values, not taking synergies into account. This is based purely on arbitrage or financial economies. This business could potentially be worth up to $24.7 million. We, of course, did the same thing. The range is $24.4 to $25 million. Our implied revenue multiples are 1.8 times revenue and almost between 10 and 11 times EBITDA. So that's investment value. So Project Zulu is worth $10.8 million to Henry. If he were to sell it to his son or his children, he would need to sell that business somewhere in the $10 or $11 million range. This business can be worth up to $24, $25 million to a strategic acquirer based on a variety of factors that we're going to get very heavily into in Valuation 102 when we start to talk about synergies and how to execute a sell-side process. We'll talk about how we can capture as close to that $24.7 million as we can. But that's a broad range. So from an implied revenue multiple perspective, 0.8 times revenue all the way up to 1.8 times revenue. And again, we did not use multiples to drive our valuation. Multiples here were calculated after the fact. They were calculated after we determined the value, and we're using them to describe value, not drive value. So far we've determined fair market value and one iteration of investment value without taking any synergies into consideration. Now I think it's time to head over and take a look at the market approach. So when Henry came in, he had heard pest control businesses sell for one-time sales. He had also heard rumors that others have been selling them for 1.1, 1.2, 1.3, 1.5, 1.6 times sales, 5 times EBITDA. He wanted to know what multiple to apply to his business. So we're going to go ahead and give him a little bit of an example. I mean, basically what the market approach tells us is that valuation is relative, and we can look at what others have paid for similar businesses and impute a value for our own business. So we explained it to Henry using an example here. Let's say Joe's Pest Control was acquired for $1 million. If we know that Joe's generated EBITDA of $200,000 for the trailing 12 months, then we know that the enterprise value to EBITDA multiple was 5 times. Now, let me interrupt myself here. I know I keep referring to EBITDA. Some of you folks on this call probably don't know what that is. I would actually consider yourselves better off since you don't know what it is. But it really means interest before earnings, taxes, depreciation, and amortization. If you're on the sell side, you're selling your business to somebody you're not related to, using EBITDA as a cash flow, a proxy for cash flow, is fantastic because it tends to overstate your earnings. If you're out there buying businesses, you never want to use EBITDA for anything. And again, we'll talk about that in 102. But for now, $1 million was a purchase price. We bought $200,000, and again, I'm going to say cash flow, even though EBITDA is not cash flow. But for simplicity's sake, we're going to use it. $1 million for $200,000 in cash flow. That's a 5 times multiple. So, if our pest control business generates $500K in LTM EBITDA, and we apply that 5 times multiple, we can, I guess, somewhat expect to sell our business for around $2.5 million, or 5 times trailing, as they would say. Of course, that's extremely simplistic. The problem is this approach assumes that every seller is the same and all acquirers have the same motives and risk tolerances, which is absolutely not the case. There's tremendous amounts of distortion that arise from using the market approach. And the market approach should only be used by individuals that really have a lot of experience using it and can understand what distortions can arise from the market approach. For you as executives and owners of pest control businesses, I'd tell you to shy away from the market approach at all cost, and we're going to talk about why. So back to Joe here. His business sold for 5 times EBITDA. Now, if we remember from earlier in the discussion that the value of a business is the cash flow stream divided by the level of risk less the amount of growth. So we don't know whether or not Joe's business was growing at 4 or 5%. We don't know what the acquirer's required rates of return are, but we backed into it because we knew right now, okay, he was doing $200,000 in cash flow, give or take. The business sold for 5 times, which equaled $1 million, and we're going to use a 24% discount rate and a 4% growth rate. That's the growth rate in free cash flow. The problem is applying that to our business. What if our business is growing faster than Joe's? Well, we don't know what Joe's business, what the growth rate in free cash flow was, but if we're also doing $200,000 in free cash flow, we use the same required rate of return. If we're growing at 10%, our business is now worth $1.4 million versus $1 million. So multiples become very difficult to use, and every single pest control company, for the most part, is growing at a different growth rate. We take the 2012 PCT 100. Here's the top 100. Actually, it's the top 90, really, because 10 didn't print a growth rate. But the top 90 and the top PCT 100, we see growth rates from -6 all the way up to, I don't know, what's that, about 32%? It's wild and wide variety of growth rates. So that's one reason not to use transaction multiples. What if our business is a higher degree of recurring revenue, which means we have lower risk? So instead of a 24% required rate of return, we might need to use a 20%. That yields a $1.25 million value. So again, the market approach is it's how to value a business relative to other acquisitions. It's based on the principle of substitution. You wouldn't go out and pay any more for a particular asset if you can get a similar or substitute for a lesser price. Now, there's more dangers in the market approach. In the pest control industry, folks tend to rely a lot on revenue multiples, which is extremely dangerous. And here, as the largest appraiser of pest control companies in the entire world, if there's one claim to fame that we have, it's that our accredited and certified staff has appraised more pest control businesses than anyone else all over the world. And we've pulled a transaction database. We got a transaction database, evaluation database of over 325 transactions in the pest control space. So we looked at I guess it was about 325 or so over the last 13 years, and we whittled it down to the last 2 or 3 years, pulled out 27 transactions. Of those 27 transactions, the total aggregate transaction volume was $679 million. So 27 deals worth a total of $679 million. The median and the mean revenue multiple is 1.1 time. Now, people love to throw around medians and means. What's the going rate? Well, a lot of people say the going rate's 1 time sales, 1.1 times sales, 1.2 times sales. Looking at actual transactions, so these are actual transactions, $679 million worth, total number of 27 out of the last probably 2.5, 3 years. 1.1 times is the median, and I only see one company in this entire chart that was acquired for 1.1 time revenue. Half of them were above that level, and the other half were below. So, of course, you start using means and medians. Where does your business fit in vis-a-vis everyone else? Well, that's really impossible to tell. It's impossible to tell because you have no information on the growth rates of those other businesses, the level of profitability, the level of recurring revenue, and you don't know the motivations and this level of sophistication of the acquirers. So there's a lot of information that you don't have. And, of course, this is where we get rules of thumb. It's the market approach where we ultimately get these rules of thumb that float around that are so very dangerous. This is a selected comparable acquisition schedule. These are actual real transactions here. I've kind of removed, I've sanitized them, but these are real pest control deals. And if we look at the top transaction, for example, when we talked earlier about transaction multiples, it's very simple. When you look at a revenue multiple, it's the aggregate purchase price divided by the trailing or LTM latest 12 months revenue at the time of the acquisition, that gives you the transaction multiple, 1.2 times sales. Again, the market approach tells us what other companies have sold for as a multiple of sales or some proxy of cash flow. And I say some proxy because EBITDA and EBIT are not cash flow. But the issue is multiples are calculated after the fact. So that deal that we just talked about that was acquired for $13.4 million, that 1.2 times sales didn't drive the deal. What drove the deal was the discounted cash flow analysis and the internal rate of return analysis that we discussed earlier in the income approach. The multiples, just like we had implied multiples, this 1.2 times is used to describe the deal. So multiples describe deals. They don't drive deals. If you walk away with anything from this presentation, I want you to understand that your business has a range of values. It's not like a house where you just look at the comparables in the neighborhood and determine, okay, mine's a little nicer, add a few bucks, done. No. Your business is a system. It's a living, breathing organism. It has a range of values. Multiples describe deals. They don't drive deals. Those are the two things that I want you to remember from this presentation. So, unless we have information or information's public on transactions, the market approach tells us nothing about the company's growth rates, its level of recurring revenue, average pricing, resources and capabilities, or even the transaction structure. Somebody pays $10 million for a particular business, while $10 million up front at close is very different than $5 million up front and $5 million over 25 years. So it doesn't even tell us the transaction structures, which all that distorts and skews multiples as well. I know I'm beating a dead horse here with transaction multiples, but is one of those things that I think it's extremely dangerous in this industry, because I think people leave a lot of money on the table because they rely on these transaction multiples. Let's say, for example, company A sold for 1.3 times revenue or 6.5 times EBITDA. Again, that 1.3 times revenue describes the deal. And just as I could say that company A was purchased for 1.3 times revenue, I could very simply say company A was sold for 2.5 times or 2.5 million times the number of pens in the company's desk, or 200,000 times the number of vehicles on the company's lot. These would all be equally accurate statements if, in fact, it did sell for 2.5 million times the number of pens. These are descriptors. I can say X number of flowers, X number of employees. These just drive deals. They don't describe them. One other thing to remember about comparable acquisition analysis is comparables or multiples provide us some sort of proxy for investment value, or what a business is worth to a strategic acquirer, if in fact it was a strategic acquirer that did the deal. It doesn't tell us what fair market value is. And so fair market value is important because when, for example, if you're doing an S election, if you're gifting stock to your children, if you've got estate tax issues, fair market value is always lower in the pest control space, which has a positive impact on the amount of taxes you'll pay. Furthermore, fair market value is a standard of value for an internal deal, again with your children or management, not investment value. So that's why multiples don't help you there. That difference results from the control premium that acquirers will pay to control a business, as well as the synergies that are part of the deal. So, in closing, to the market approach, it should only be used as a sanity check. You start getting 2 times sales, 3 times sales, you got to start checking your numbers. So the market approach should be used as a sanity check to check your discounted cash flow and internal rate of returns analysis. Again, multiples are derivative. They're calculated after the fact to describe transactions. Now, we've already talked about the private and the public markets being very different. In the private markets, you might have a business doing $1 million in free cash flow. And because you are operating a private company in the private capital markets, your rates of return might be somewhere close to 25%. So your business kicks off $1 million in free cash flow. Your business is worth $4 million. But although technically impossible, if we were theoretically to move that business to a public exchange and now made you a publicly traded company, Your $1 million in free cash flow with a 10% required rate of return would be valued at $10 million. So just from the fact that you are a private company and not a public company means a dramatic difference in value, $4 million versus $10 million. What we just talked about describes the theory behind arbitrage. And so arbitrage is the near simultaneous purchase of sales and securities in different markets in order to profit from price discrepancies. Orkin, Terminix, and Rentokil do this. Well, Terminix obviously not anymore because ServiceMaster is private, and while they do intend to go public, we'll see if they get there. But they do, their cost of capital is quite low nonetheless, so they can profit from this. But essentially what they're doing is they're buying companies in the private market where there's higher required rates of return and selling it to investors, so to speak, in the public markets. Now, even though you own a private held business, can create a tremendous amount of wealth if you can discover and exploit this risk-return imbalance in the market. I want to talk about that. In the pest control space, the market's typically segmented into three broad classifications. We got the micro segment, which is $1 million in sales or less. Or nowadays, it's really closer to $600,000 or so or less in sales. We've got the middle market, which is companies doing typically $1 million to $3 million, $100 million in sales, and then of course the publicly traded market. If we, as Project Zulu, pretend we're Henry for a second, we go out into the micro market and we buy a small pest control business doing $100,000 in free cash flow. In the micro market, required rates of return are typically between 30 and 40%. So we go out and buy a business from somebody utilizing a 33% required rate of return. We pay $300,000 for it. Even if we realize zero synergies the day we close that deal, just for the fact that Project Zulu is a much bigger company in a different segment of the market, that $100,000 in free cash flow, as soon as we put it on our books, is now worth $400,000 because we have a lower required rate of return. Our business is bigger, it's less risky, and therefore we have a lower cost of capital. So we create, just like the Federal Reserve prints money, well, now we're printing money because we just created $100,000 in value out of thin air. Now, as Project Zulu, we've added that additional $100,000 to our P&L. Now we turn around and we want to sell our business, Project Zulu, to Orkin or Terminix, Rentokil. That $300,000 we spent in the micro market is now on the very next day worth $660,000 to us. Why? Because, again, cost of capital is different in the public market. Now, we're not going to be able to share all that value created through financial economies, but we can share a good chunk of it. So we bought it for $300,000. It's worth $400,000 to us now. We turn around the very next day. We sell it for $660,000. Pretty nice move if we learn to do this right and we begin to meticulously quantify our investment opportunities, establishing hurdle rates just like the public companies do, and running all investment and capital budgeting decisions by a hurdle rate. When we go out into the market, we can utilize that hurdle rate as kind of a yardstick to measure the returns we'll get from some of these smaller businesses. Now, as we start to talk a little bit about a preview from 102, we're going to get into the strategic rationales for acquisition. And so usually companies like Terminix and Orkin and Rentokil will buy businesses for one of the following reasons. That's to acquire new capabilities or add to existing ones, to establish a new business model, to lower costs, to improve market position, or arbitrage, which is something we just discussed. They get returns via revenue enhancements, cost reductions, process resources and capabilities, and financial economies. This is how acquirers are able to create value by doing transactions. The last thing I wanted to discuss before we'll get to Q&A, and I can see that there's going to be a lot of Q&A because the dialogue box is pretty full now with questions. I'll talk about the fact that the market is dynamic. And in order to do that, let's pretend for a second that we're hopping into a time machine and we're going back in time 10 years. So Today is September 16th, 2013. We went back in time 10 years and a day to September 15th, 2003. And we landed at a closing table. And at the closing table, the owner of a pest control business was about to sell his company for $10 million. He owned a C Corp, and he was only able to sell the assets because no one, at that point in time, no one would purchase the stock of his company. Total proceeds were $10 million. After corporate and personal taxes, he ended up with $4.62 million in his pocket. Now, if we were to grab him from the closing table and bring him into the future to September 15th, 2013, a different thing would take place. So if he had the exact same company with the same financials, same performance, everything, nothing's changed, we've just moved it now into the future, that exact same business, same financial performance would sell for $14.6 million because the market is dynamic, it changes. Further, our owner would be able to sell his C corporation as a sale of stock as opposed to assets, which would save him millions of dollars in taxes. So by moving into the future 10 years, doing the exact same deal with the exact same company, the owner put 240% more in his pocket. The difference between almost $11 million and $5 million. It's dramatic. Now, why does this happen? Well, I've been in the industry for a long time, and unfortunately, we hear the same rules of thumb spouted out by all sorts of knucklehead consultants and owners that don't know, and just random folks in the industry. Always hear about one-time sales, one-time recurring revenue, this, that, or the other. But if we open our eyes and we look at the equity markets, this is the Wilshire 5000. So from 1971 till present, look at the dramatic increase in the public equity markets. This is all traded equities in the United States. This is the basket of all of them. This is the whole market index in the U.S. Right now we're at an all-time high. And of course, people scratch their head and say, well, we're still in the doldrums of a recession. Why are equities at an all-time high? Well, the answer to that question is the Federal Reserve and central banks around the world are printing a tremendous amount of money, and that needs to go somewhere. And so when you're printing trillions of dollars, when you're printing 85 billion plus per month, that goes someplace, and that's going into real estate, it's going into the bond market, it's going into the equities market. If we look at Rollins stock, and I like to look at that as a barometer, and we use the backdrop of the monetary base published by the St. Louis Federal Reserve Bank, we can see Rollins is the black line. The blue bars is the monetary base. So in 2007, the Fed had $852 billion in cash on its books. Right now, as we approach the end of 2013, it's got over $3 trillion. So it's printed a couple $1 trillion in cash out of thin air over the last 4 or 5 years, and that has gone into the equity markets. Look at Rollins. It shot up almost in tandem with the Federal Reserve printing cash. At Potomac here, we have a cap rate index. So we have the PPCG, which is the Potomac Pest Control Group cap rate index, and this particular chart shows us the inverse of capitalization rates paid for pest control businesses, utilizing that. We looked at over 325 transactions over 13 years. This looks at the last 10 years, but you can kind of see how transaction multiples have creeped up over time. 2012 and 2013, they've really hit their zenith, and that's tied to that black line, of course, is the monetary base. As the Fed continues to print money, not only is money going into real estate and public equities, but it has increased the value of your pest control business, at least on paper. Now, our research staff put together projections for 2014. Some folks here believe that the market and pest control will ultimately revert to the long-term mean by this time in 2014. I'm not so sure about that. I believe that the Federal Reserve will not taper quantitative easing. I think it's absolutely impossible, and they're going to keep that up into perpetuity. And I think that these transaction multiples will continue to increase. So I think in 2014 we'll probably see another blue box, and it'll probably be higher than the one in 2013. I love this chart. This explains, there's a tremendous amount of information in this chart This is the PPCG cap rate index, the Potomac Pest Control cap rate index. This looks at and measures with extreme accuracy the capitalization rate. So a cap rate is the discount rate minus the long-term growth rate used in discounted cash flow models for valuing pest control businesses. The black line is the implied year one internal rate of return that strategic acquirers get on acquisitions. So both the cap rate, the blue columns, and the black line, the lower the number, the higher the implied value of the business. And you can see in 2012 and 2013, we believe that implied year one internal rates of return have reached an unsustainable level. That means the value that acquirers are paying are below their hurdle rates. So they're getting pretty close to costs of capital. The blue line is the interest rate. And interest rates have been held down artificially based on the fact that the Federal Reserve, every time the Federal Reserve prints money, interest rates fall or remain depressed. Interest rates hit an all-time low in July of 2012 based upon the GS20, which is the good proxy for long-term interest rates published by the St. Louis Fed. July of 2012, it hit a floor, all-time low. And since the summer of July 2012, interest rates have increased 150% as the Federal Reserve entirely loses control of long-term interest rates. I personally believe that, again, they're not going to taper quantitative easing. I think the Fed will actually have to accelerate quantitative easing and print more money just to keep the economy on life support. I think if they taper this, it's going to make the Great Depression look like a picnic. And of course, the federal, the regulators, Congress, every moron in Washington is making every wrong decision they can possibly make, and it's a shame to see, what I've always believed to be the greatest country in history catch on fire with all this nonsense in D.C. But here it is, guys, right before our very eyes. Our government is manipulating the price of everything. It's even manipulating the price of your pest control business through pumping liquidity into the market. This last chart kind of depicts the man from the time machine. Back in 2003, he was doing, I don't know what he was doing in sales right now, but what I can tell you is his offer was $10 million. And you can see how it creeps up over time. Where, by 2005, 2006, he's at 10.4 million. And then it goes all the way up till, 2012 and 2013, 14.2, 14.6 million. So the market is not static, it's dynamic. The value of your business changes. Now, it might not be as dramatic as overnight, like the public equity markets, but I view this, in my experience and judgment, I view this as a pretty authoritative study. This takes all the relevant data and this is it, guys. This is how the value of your pest control business or the industry at large has changed over time. Where it ends up next year or 2015, well, I don't know. Your guess is as good as mine. So we covered a lot of ground today. We talked about the fundamentals. A lot of it was repetitive. Some of it was unclear. We've got, probably 60 or 70 questions that have popped up in the box, and we're going to get to that momentarily. For those of you who are joining us live, I wanted to thank you. I always appreciate you folks taking the time to listen to me. I learn just as much working with you as you do from me. So again, thanks for joining me today. It's a pleasure. Those of you who are listening online, if you're looking on our website, we'll have a comment box below. If you got value out of this, I'd like to know about it. If you didn't get value out of it, I'd like to know about it. And if you have questions, we'll probably be doing some follow-up Q&A to this because this presentation, has covered a tremendous amount of information in a very short period of time. There's a lot of questions. So put your comments, put your questions on the web. You can send them to me at paul@potomaccompany.com. You'll see it on there. Our website for our pest control group is different than our main company site, and that is potomacpest.com. We're going to take a 2-minute intermission here, and I'll be right back to begin to answer these questions. Thank you. All right, let's get this started. We've got a lot of questions to go through. Starting with John. Thank you for the awesome information today. I have 2 questions for you. Number 1, are you going to be at Pest World this year? If so, I would love to buy you a drink. John, I will absolutely be at Pest World this year, and I too would love to get a drink with you, so I'll happily accept. Further, any of you other folks listening to this want to get together in Phoenix this year, my email and phone number's there. I'd be happy to chat with you, to get together with you. Just send me an email or give me a call. Question number 2, going back to the chart that shows interest rates and IRR, can you explain IRR and what that means to us? That is a fantastic question. John, I'm assuming you're talking about this chart here, which shows the long-term mean IRR is between 14 and 16%, and then we've got them dipping down. So I think this is a great opportunity to take this presentation completely off the rails and go to the transaction model. So this is a transaction model or a detailed cash flow model. This is the discounted cash flow page, which we have gone through already. Whenever we do an engagement, we set something up like this. This is I think probably the most interesting thing for you folks on the call is this is the exact model that the strategic acquirers would use to value a business for an acquisition. And, while it's not the exact model for all, it is the exact model for at least one multi-billion-dollar acquirer. And I know that because we built it for them. So we use the same model. Different assumptions, but so here's the discounted cash flow page, and basically discounted cash flow, what this tells us is based upon the level of risk of the business, recurring revenue, strategy, people, architecture, routines, culture, so on and so forth, we come up with a cost of capital or required rate of return. We plug that in along with the detailed projections of, we got the income statement, the balance sheet, statement of cash flows, so on and so forth. This provides us a spectrum of purchase prices. So from a fair market value perspective, we're somewhere in the $10.5, $10.6 million range. Now, the internal rate of return model does something a little bit different. We plug in a purchase price, and it tells us what our returns are. So the large strategics, as a function of corporate financial policy, will have what's called a hurdle rate. And I constantly tell my clients that they should establish hurdle rates as well, because what a hurdle rate does is it's a required rate of return for investments, whether you're opening a new office, whether you're buying new equipment, whatever you're looking to do, whatever sort of capital budgeting or investment decisions your firm is looking to make. The projection of cash flow or the target return has to exceed the hurdle rate. So, of course, companies like Rentokil and Orkin, so on and so forth, they use hurdle rates for all investment avenues, acquisitions being one of them. And if you look at a company like Orkin, for example, Orkin's weighted average cost of capital is approximately 8% at present. Now, in order for Orkin to create value by doing a deal, they're not going to target a 5-year IRR of 8%. They'll have a hurdle rate that'll be higher than their cost of capital. So, again, the internal rate of return model, we plug in a purchase price, and it gives us our return. And so if we set this up, if we're advising Henry on the sell side, what we can do is populate this model. We can determine what his fair market value is, and then as we are going through process, as they say, if we're selling it to a third party, we can put in projected synergies for Rentokil on Arrow, Terminix, Massey, so on and so forth. And we can calculate potential purchase price scenarios for each acquirer. So we can basically determine a fully vetted investment value, and then of course during the sell side process, it's our responsibility to fight to get above fair market value and as close to investment value for each acquirer that we can. Now, this in my mind is absolutely paramount in, when you're selling a business. You want to do this analysis because you want to have a sophisticated conversation with acquirers as to what their potential returns are. 99.9% of guys, especially those unrepresented, go into this and say, okay, I have no idea what my business is worth. I've heard random transaction multiples, 1.3 times sales, 1.5 times sales. I have absolutely no idea where my business fits in, but I'm going to go out and get the most that I can. They talk to an acquirer, sometimes two. They don't understand that there's no such thing as a going rate, that every acquirer will look at it different. And they don't even know what acquirers are looking at to value them. So you're looking kind of behind the scenes. So to give you an example of an internal rate of return, if I am an acquirer and I'm looking at Zulu, I might calculate fair market value at 11.5 million, and I might figure out and say, okay, I've got a 15% hurdle rate, for example, which is what's in this model right now. And if I do this as an all equity investment, so no debt, I'm just using all equity. If my hurdle rate is 15%, I can afford to pay $16 million for this business, which is 1.17 times sales and 7 times trailing EBITDA. Now notice, we didn't use transaction multiples. We didn't use sales multiples or EBITDA multiples to drive the deal. These are calculated and they're implied by the purchase price. What we're doing is we're entering the purchase price. So historically, 15% was kind of in the middle. Now it's dropping down. So if an acquirer, again, we're not using synergies. In 102, we'll talk about synergies. Right now, this is just a standalone value. It has nothing to do with synergies right now, but based upon the standalone value, if I'm okay with getting a lower internal rate of return, what I might do is, let's see here, if we plug in a purchase price of $19.4 million, that gets me 11% internal rate of return over 5 years. My implied purchase price as a percentage of sales is 1.42 times sales and 8.5 times revenue. So as an acquirer, I can say, okay, I plug in 19.4. I'm okay with bending my returns, so to speak. If my hurdle rate's 15 and I need to be strategic and I need to get this target for whatever reason, I can, as they say, bend returns down to 11. And when I make my offer to the seller, I can describe the deal in terms of sales multiples and EBITDA multiples, even though this didn't drive the deal. Now, the typical unrepresented seller will look at that and solely be focused on sales multiples. But the reality is, this is all the stuff that's going on behind the scenes. Now, when we talk about fair market value, there's no way your son or your employees can get an 11% return. I mean, they need to be targeting at least a 25% return and sometimes a 30% return. Pest control businesses are, largely intangible, so they're hard to finance with debt. But if you can finance it with debt, let's take a look at the financing structure. Let's change the financing structure to, we'll use 46% debt, 53%, well, no, a second. Why don't we do, So if we use a chunk of debt to do a deal at $19 million, our return is 18%. Let's take this down a notch. We'll go down a turn and a half, 27. That's a good IRR target. So if our son can come up with a good chunk of equity and somehow finance it, or you're able to provide your family or your managers a cheap source of debt, they can afford to pay $16 million for this business, which is 1.17 times sales, and target a 27% internal rate of return. This is a great way of doing it. This is the way all the sophisticated parties do this. And a lot of times you've got owners and managers kind of sitting in a room, owners batting it out based on sales multiples, which is not a great way to quantify returns. And I always scratch my head because a lot of folks in the pest control industry, they own commercial real estate, they own stocks, they own bonds. They know what they need to invest. If I need to invest $10 a share and I want a 10% return, I better get $1 in appreciation or $1 in dividend. They do the math. They look at their returns. They look at the risk. But when it comes to buying and selling businesses, it amazes me that folks utilize random multiples that don't actually describe the returns or the risk of the deal whatsoever. So this is how a transaction model works. So you guys, I think this is probably one of the first behind the scenes for a lot of you folks. Let's go on down to a next question here. Based upon your presentation, are you saying now is the best time to sell? I don't know if that's necessarily what I'm saying. I think if, over the years I've given all sorts of interviews for PCT Magazine, and, I know last year Ann Nagro asked me if now was a great time to sell, and that was in 2012, and I said it's a fantastic time to sell. In hindsight, 2013 is a better time to sell. What will 2014 bring? I don't know. If the Fed continues with its reckless monetary policy, it most likely will not be worse. It'll probably be about the same as 2013. We use the example of the, asset purchases were the norm 18 months ago. Nowadays, for the first time in modern history, large acquirers are doing stock deals. So if you've got a C corporation, you're able to completely do away with an entire layer of taxation, which tends to be close to 40% in the United States, based upon the fact that you're able to sell stock and no longer just assets. And I think we're seeing a lot of stock deals now. And it's changing all around the world. I mean, we do transactions. I split my time between I spend about 3 or 4 months a year in the United States. The rest of that time is overseas in the Middle East and Europe. And we operate on 25 different countries. So it's a robust market all the way around the world. And it's fueled by cheap money and a lot of liquidity that these central banks are pushing into the market. So right now is a great time to sell. I don't want to be the guy, you got a lot of these business brokers that run around and you talk to them and every year is the best year ever and the sky's falling. If you don't sell now, you're going to lose out. And as executives and business owners, you need to focus on creating value in your own business. I think it's important to time the market to a certain degree. It's important to watch the market. And I would stay close to sophisticated advisors that are able to provide you this sort of information. So right now it appears that we might be at somewhat of a zenith. Will that zenith continue? Yeah. Your guess is as good as mine, but I don't think you need to run to the exit. You might want to start to dance a little bit closer to the exit, though. Dan says, if you were looking to buy Zulu, what would you offer to pay for it and why? Whew, that's a great question, Dan. This is an abbreviated example, and I don't want to give you the it depends type answer, but it does depend. So instead of giving you, let me give you my thought process, and this is how I would do it. When I work on the buy side, and we are the exclusive advisors to the pest control industry to a multi-billion-dollar public company. We do, on occasion, work with some smaller middle market businesses. But when we're on the buy side, it really depends upon the level of sophistication of the sellers as well as the level of sophistication of their representatives. So in the industry, you have investment bankers and you have business brokers. Potomac is an investment bank. We're a strategy consulting, valuation, advisory, and investment banking firm. Every one of us has extensive Wall Street experience at some of the biggest investment banks in the world. All of our appraisers are accredited by the American Society of Appraisers, the Institute of Business Appraisers. They're all certified and accredited, whereas I don't know any other firm in the industry that has accredited appraisers that operate in the pest control space. A lot of the business brokers out there tend to be former pest control operators themselves that have neither formal training nor years of experience doing deals. I look at them as glorified real estate agents, and their whole goal is to take a finder's fee and put a deal together. I tell most sellers that, your investment banking advisor or your M&A advisor, his job is to not go out and find buyers for your business. I mean, idiot can do that. all you need is a phone book. I mean, look around. The biggest payers are those with the lowest cost of capital. So 90% of transactions are done by Orkin, Rentokil, Terminix, Massey, Arrow. I mean, these are the companies that have the capital, the capacity to pay, and the low cost of capital to do deals at higher prices. You have regional players, and there's a lot of great deals done by middle market firms. And that's an exit opportunity for a lot of smaller businesses, like in the micro end of the market. But a lot of these business brokers are not particularly sophisticated. So you either would have an unrepresented seller, a seller represented by an unsophisticated business broker who's solely focused on getting a fee. He's not focused on doing any of this hard analysis here to determine purchase price scenarios and calculating potential investment value. In fact, none of these guys, in my mind, even know how to operate these financial models. And then, of course, you have sophisticated advisors. If you're dealing with a sophisticated advisor, you know it's going to be an auction. You know the advisor is going out to all the largest acquirers out there, and you know it'll be very competitive. So you need to come in a little bit higher. So you want to first calculate your fair market value, determine what the business is worth to the sellers, determine your highest, actually, let's do something a little bit different today, and I'm not too used to doing this, but I'm going to do it now. Let's go to the whiteboard. If you have you start by calculating, you calculate your fair market value, you calculate your fully vetted investment value, and then if you have a sophisticated advisor, you'll come in north of fair market value, but you want to give yourself a lot of room to negotiate up, because when you're dealing with a sophisticated advisor, you've probably got somewhere between 2 and 5 rounds. That means you put in your initial letter of intent, it gets batted around, you got another letter of intent, there's counter offers, so you got to be prepared for a lot of fighting. With a sophisticated advisor, you can probably get away with asking for expectations. When you're dealing with somebody that's unrepresented, a seller who has no idea how to value a business, he's in the process of executing his most important transaction of his life. He's his own advisor, and he's got the proverbial fool for a client. You want to probably be in a position to frame the discussion. So most of these guys want 2, 3, 5 times sales, some absurd number. Any of you guys who've ever been involved in buying pest control businesses have dealt with this before. You want to give yourself room, but you don't want to ask for a purchase price. You don't want to ask for an asking price from a seller who you know is going to be unreasonable, because then you've allowed them to frame the discussion. So most likely somebody that owns a company the size of Zulu will be a little bit more sophisticated than somebody that might own, not for nothing, there's a lot of very sophisticated guys that own $1 million businesses, and those $1 million businesses are going to become $50 million businesses at some point in the future. But the guys that own the smaller businesses, you want to be the one to frame the discussion. Don't ask for a purchase price or an asking price. Say, okay, this is what I'm willing to offer you. Here's fair market value. And I would start at fair market value and explain why, and let them negotiate up from there. Now, if you're buying a business, one of the best things that could happen to you is one of these guys, that advertises in the back of PCT magazine saying, the buyer pays my fees. I'll give you a free appraisal. I'll throw in a kitchen sink and a sundae, all that kind of jazz. These folks they provide no value to the seller. They're only concerned in going out there and getting a fee. What typically happens in the industry is, if the buyer is paying their fee, you got to remember there's no such thing as a free lunch. So if you want to be penny wise and pound foolish, the guy that's getting paid by the buyer will only show your business to buyers that pay fees. And of course, the buyer who's willing to pay the biggest finder's fee, of course, will end up winning the deal. So sometimes these business brokers that take fees from the buyers are great, because they turn around and they tell the seller, I'm representing your interest, but the buyer's paying me. And then letters of intent from buyers that are willing to pay more for the purchase price, but not such a big finder's fee or no finder's fee at all. Somehow those LOIs start to end up in a trash. It's unfortunately particularly sad, but it happens every day. In 102, we'll really get into this. In 102, 103, and 104 will be the buy side. So, Dan, I'm sorry to, I hope that helped you. Chris says, Paul, thank you for today's presentation. I'm looking to buy out my partner. I spoke to a business broker who calls me constantly, and he said that the going rate is one-time sales plus inventory plus equipment. Sounds like you are saying something very different. Please help! ! Chris, no such thing as a going rate. Every buyer has a different perspective of value. Of course, this is one of these old-timer business brokers who every year it's one-time sales. Let me throw together a quick deal for you. It's a bunch of nonsense. It's unfortunate because, a lot of these guys end up ruining retirements for people that are, unknowing, so to speak. One about your partner, that's an entirely separate issue. We'll talk about it very quickly. So when you buy out a partner, the standard is fair market value. So that's going to be lower than investment value. You've got other issues. So Chris, what does your partner own? What percentage of the business are you trying to buy out? Chris, you there, Chris? Okay, 30%. So Chris is trying to buy out, and I'm assuming, Chris, you own 70% of the business? Okay, so Chris wants to buy out his 30% partner. So let's say, for example, hold on a second, guys. Let me move this is difficult to do here, but I'm going to try to do it. I'm a left-hander. I think I have pretty good writing, but I'm not used to writing on a computer screen. So let's say that your business is worth $100, okay? So typically what ends up happening is, and we do this all the time in our valuation practice, a lot of these business brokers give bad advice and then it turns into situations like this. Typically what ends up happening is, let's forget about valuation right now. Let's talk about the process of buying out a minority shareholder. If a business is worth $100, Chris, you own 70%. Your partner owns 30%. So most folks would look at that and say, okay, you pay your partner $30 and it's an end of story. But the issue is your partner owns a minority stake in a very illiquid asset. There's no market or at least there's no liquid and ready market for a minority stake in a pest control business. So when we do appraisals for minority buyouts, we have to add something that's called a minority interest discount, or a discount for lack of control. And then there's another discount called a discount for lack of marketability. So if the pro rata value is $30, we might have because he only owns 30% of the business and it's an illiquid market, we might end up subtracting another $5 for a minority interest discount. And then we might end up discounting it and subtracting another $5 for a discount of lack of marketability. So at the end of the day, his $30 share is only worth roughly 66% of what you would otherwise believe it is. As appraisers, I typically tell my clients, they say, should I get an appraisal? I want to figure out how much my business is worth. You don't need to get a formal appraisal. Formal appraisals can run into a lot of money. However, there are certain circumstances where you need a formal appraisal. If you're going to court, or if you could potentially go to court in a shareholder buyout or a divorce, or for compliance issues, if you're gifting stock or electing to convert your business from a C Corp to an S Corp, something's going to the IRS. Well, all these compliance valuations you got to pay for. It's unfortunate, but it is what it is. So you need a high level of assurance that an expert spent the requisite amount of time doing the analysis. So for a partnership buyout, you probably want to get a formal appraisal, and you and your partner should determine and agree upon an appropriate appraiser, and move forward that way. But this gives you I'm hoping that at least this gives you an idea that when you own anywhere less than 50% of a business, it's not value of the business minus 50%. It's value of the business less the 50%, less a discount for lack of control and a discount for lack of marketability. And those can be anywhere from 5% to 25% each. So, that's how that works. What else do we have here? Ryan says, how do you know what methodology an acquirer is using to value a business? Well, if the acquirer is one of the big three, or a company like Arrow, for example, you can count on them being very sophisticated, and they're going to be using the internal rate of return model and the DCF model. Those are going to be their primary tools. If they're not particularly sophisticated, who knows what they're going to be using. And again, I keep saying we'll be going into this, but I'm trying to distill 45,000 hours of experience to you guys in a very short period of time, and I'm hoping to do it over the course of the next few lessons. Jim says, which acquirers pay the most in this current market? Again, there's no such thing as which acquirers pay the most. We auction, every deal we do is typically a controlled auction, so all of the acquirers are bidding on them. Sometimes Rentokil wins, sometimes Orkin wins, sometimes Terminix wins, sometimes Arrow wins, sometimes Massey wins. So there's no such thing as which acquirers pay the most in any market. The proper thing to do as a seller is determine your fair market value, determine a spectrum of purchase prices for each unique individual acquirer, take it out to market, and do what's called price discovery. Have multiple rounds of bidding, make the process very competitive, and this is the cornerstone of Valuation and M&A 102, which we'll be doing in mid-October. Michael asks, Paul, what's the best way to get a win-win deal with an acquirer? Well, I'm not exactly sure what you mean by that. I don't know if you mean you got a satisfactory amount of money and the acquirer didn't overpay, but as far as I'm concerned, a win-win deal is not even in my vocabulary. I know a lot of business brokers run around and they talk about, getting a win-win deal and high five and this, that, and the other. I think that's a load of crap. When I am representing a sell-side client, my exclusive goal is to get my client the absolute most amount of money as I can, period. The shareholders of Rollins, the shareholders of Rentokil and Terminix, these guys are sophisticated. They got more money than us. They have executive management teams. They can take care of themselves. I'm not concerned about acquirers. I'm not concerned about a win-win deal. When I do a deal, when I sell a sell-side client, I want the acquirer to walk away from the closing table. I want the corporate development guy to look at the division president and say, man, this better work out because I think we really overpaid for this business. That's what I want to happen. If you feel like you need a win-win deal, I think what you need to do is get the most you can for your business and then find a family that has a hard time making ends meet and buy them food. Find a kid who doesn't have money for an education and support him or her. That's what you should do, but you should not worry about a win-win deal because look, at the end of the day, you're the one that's taking the risk for decades. You had a hard time paying your mortgage. You made sure that your employees got paid before you. You provided fantastic service to your customers and livelihoods to your employees. And sure enough, these governments around the world are going to be with their hands in your pocket when you're selling. So a good chunk of your deal is going to go to taxes. You shouldn't be worried about a win-win deal. You let guys like me worry about that. You worry about running your business, being as sophisticated a financial manager you can, building up wealth and value in your company, taking care of this other stakeholders, your employees and your customers, create value for them. And then when it's time for you to sell, it's time for you to be ruthless. Forget win-win. Folks, we've gone quite a bit longer today than I thought. Unfortunately, we have a lot of questions coming in. So what we're going to do is we're going to stop it here for today. Anyone who's asked questions that I didn't answer, I tried to give longer responses to hopefully answer as many questions as I can. Still got a lot more to go. So here's what we're going to do. We're going to stop for today. Tomorrow you'll get another invite for a live session in the next few days. If I've answered your questions today, thank you so much for joining us. If I have not answered your questions today, I promise it'll get done. We'll record the session. The follow-up Q&A will also go on the website, and you'll get a link to it. So if you're not able to join us, just send me your questions via email, or in fact, I got the dialogue box here, so I'll know what they are. And we'll take it from there. Again, thanks everyone for joining. If anyone needs to get a hold of me, again, my contact information is here. Paul Gianamore at the Potomac Company. Paul at potomaccompany.com is my email address. My phone number is 215-827-6617. Thanks for joining us today. In mid-October, we'll be up for 102, which is exploring synergies and how to extract the absolute most for your business through a competitive sell-side process. So pushing it to investment value. Again, thank you so much, guys.